So all whole life insurance products are the same, right? The product you choose doesn't really make a difference, does it? Meaning if you're looking at a whole life insurance policy, cash value is your goal, but you see 8 different products with one company. If you're paying in the same dollar amount, does it make a difference? Well, the answer to that question is yes, it definitely makes a difference. And this is one of the most important things to be aware of because it prevents what we discussed in our last video, a lack of awareness, or prevents someone saying, I didn't know that that was an option. I wasn't aware of it. I didn't know that I could do that. Why wasn't I shown this before? Having awareness of the top products. You don't have to know every single product that's available because that can and likely will be overwhelming, but knowing what people often look at when it comes to whole life insurance products, what do corporations look at? What do the wealthy look at? What products deliver the strongest overall return, meaning when I'm looking at the internal rate of return, the net growth rate, which options generate the most cash value on a yearly basis and also long term. That's usually what people look at. So this will be a continuation of our last video where we looked at the individual funding $100,000 per year, and we looked at the different ways to set that policy up or to design it, and we saw that option C gave him the most money. So what we're going to look at is option C, but with 3 different products. This will be extremely helpful if you're looking to really maximize the growth on a cash value life insurance policy. So when it comes to different products, one thing to be aware of is that in most cases, different products can be designed in the same way or a very, very similar way. And now I did emphasize the word most because some companies do have different design limitations with different products. So if you're working with us, we'll definitely let you know about those limits and recommend the products that deliver the highest cash value. But in most cases, the design can be identical or very, very similar. However, even with a similar design or the same design, you can have much, much different results. So what we are going to look at is as follows. We're going to look at a traditional policy, a whole life 100, which is the exact same product we looked at in our last video. Then we'll look at what is referred to as a high early cash value policy, and then a 10-pay policy. And a 10-pay policy, what that represents is that the premium is due for a maximum of 10 years. Now, you do not have to pay into it for 10 years. In fact, a lot of times people we work with will move forward with a 10-pay policy because when you look at the cash value growth, it's attractive, but they'll fund it for a short period of time, perhaps only 4 or 5 years. So I like to mention that because a lot of times people see 10-pay and feel that they must pay into it for 10 years, where that is not the case. Just like a whole life 100, premiums are due up until age 100, but if you do things right, you don't have to pay into it until you are 100. You can easily stop after 4 or 5 years, again, if it's set up correctly. So what we're going to look at with these examples is as follows. We're going to see the same design, minimum premium, maximum cash value, but we're going to look at the internal rate of return, which is the net growth rate. Simply, what is the cash value growing by on a yearly basis in terms of a percentage? So let's take a look here. What we will begin with is the whole life 100 product. So as we look at this, what do we see here? This is what we looked at in our last video. We've got $100,000 per year going in. Here's your premium up top, and then we're juicing this thing for maximum cash value. Here's your cash value in year 1, just about 84%, and the break-even point is very, very close to year 6, where you are at about $599,000 and you've paid in $600,000. So just about cash positive in year 6, you are cash positive in year 7. This is our whole life 100 product. What I'll add about this is this will have the weakest cash value up front, particularly in years 1 and 2. And the reason why is because when we look at that base premium, what shows up in cash value in the first and second year, guess how much? 0. Now, dividends can be applied, which might give you some cash value from your second year base premium payment, but on a guaranteed basis, there's 0. And where you can see that on an illustration, actually right here with this column, basic policy, cash value, end year. This column represents the cash value buildup from base premium payments only. So in this example, $10,000 per year. And it assumes that dividends are never applied to this portion. So this is assuming A, you only pay the base premium, and then B, only the guaranteed rate is applied to that base premium payment. So years 1 and 2 of your $10,000 payment, how much shows up in cash value? 0. Year 3, 50% of the $10,000 on a guaranteed basis shows up in cash value. So the premium piece is really what's hurting the cash value growth when we look at it. The PUAs is what's giving us the majority of the value, especially up front. So this is our traditional policy, and that base premium explanation a lot of times helps individuals understand why the first 2 years hurt so much with this type of product. Yes, we maximized it, but by year 2, you look at this, I paid in $200,000, I've got $172, $173, still a $27,000 hit. Like, that's a lot of money. Let's look at our high early cash value product, and you'll see the same design, $100K per year going in. Here's your premium up here, same $10,000. If we look at the premium piece, see this guy? It's not a 0 in the first 2 years. In the first year, you get about 80% of your premium that is credited to cash value right out of the gates. So as a result, you're going to have a much higher net cash value because we're adding PUAs in the same manner we did with the Whole Life 100 product. Look at this. All of a sudden, the break-even point, instead of between years 6 and 7, you're between years 4 and 5. Now, what's interesting about this product when we compare it with that Whole Life 100 product is you got more money short-term and long-term based on the non-guarantees. If we look at the guarantees, the opposite is true, where the Whole Life 100 has more on a long-term basis. Upfront, the high early will have more. It's kind of in the name of the product, high early cash value. That's good to be aware of. It has a lower guaranteed rate than the Whole Life 100 product. But if this is you see 2 options. Which one maximizes your cash value thus far? The high early cash value does. You get more upfront, and when we compare the 2 side by side, you will see that it's more long-term on a non-guaranteed basis, but we're with one of the major mutual companies that we see deliver, especially when we look at real results, meaning not just illustrations. Let's look at our 10-pay next. So a difference you'll see here, or what you'll notice, is that the funding is only for 10 years. We're not funding it for 25 years in this particular example. What I usually like to do in a case like this, and I'd assume that the individual that I'm working with wants to fund it for 10 years, if they want to see the different options, we would actually look at that Whole Life 100 and high early cash value product funded only for 10 years. So now you see everything completely equal in terms of the total out of pocket, 100 for 10 years with all 3 options. The difference that I would add as far as a talking point is concerned is with the Whole Life 100 or high early cash value product. If you decide to keep adding to it, you can, whereas this, the premium stops after the 10th year, the base premium that is. So what we've got here, the same premium, $10,000. Depending on one's age, health rating, and amount they're adding to the policy, you're typically going to see somewhere between 30 and 35% of whatever the minimum premium is, the base premium, show up in cash value in the first year. So you get a nice chunk of change in cash value immediately from the base premium, and then you can plow PUAs into it on top of it. Some companies will have different PUA structures or PUA fee structures. When you look at the PUA fees with this example, or this product, they're lower than the Whole Life 100 and high early cash value. All that means lesser fees. Break-even point, year 4 in this example. So strong performance there. The high early cash value technically broke even in year 5. So this is a little bit stronger. So let's look at a side-by-side here. This will be fun. What do we got? Whole Life 100 on the left, a breakdown as to where the money is going. We do have a term rider built into that PUA payment, so not the full $90,000 is not going toward PUAs. A small percentage is going toward term, but your annual funding 100K per year. What's boxed down here is your break-even point, when your cash value is equal to or greater than your total cash value. The first year that your cash value is equal to or greater than your total payments. Then the high early cash value product. Looking at this, which one has more money? Short term, it's obvious. Let's look at the end of the funding. You paid in 2.5, high early on the right, almost 4.3. Whole life 100, almost 4.2. So I've gotten more from start to finish. So maximizing cash value is my goal. So I can then access the cash value for opportunities, and I want to fund for a longer period of time. And I'm deciding between these two. The numbers will speak to me there as far as which one gives me more value. The death benefit is higher initially with the whole life 100 product. That is worth noting and something we would look at when we are comparing and contrasting. Our 10-pay product, here we go. Funded for 10 years, very strong, earlier break-even point. If we look at year 10, you see a nice gap there in performance. What's really interesting about this, look at year 11. This is all with the same company, same individual, same health rating. Our out-of-pocket was 0. Cash value, it's about $1.25 million. Look at year 11 with the whole life 100. You paid in 1.1, and your cash value is 1.25. There's a $5,000 difference. Like, there's not much at all when we look at it. High early cash value by year 11, that we see a little bit more of a gap. But if we're comparing these two, which one is running faster? Meaning we're getting more from the insurance company in cash value growth. The 10-pay product. Look at this. By year 11, you've paid in $100,000 less, and you've got the same value as the whole life 100. Now, a big reason why is when MassMutual created these products, when they revamped them in 2021 and 2022, this product is designed for cash value accumulation, whereas this product is designed mainly for death benefit planning. Still, get the same dividend interest rate and everything applied. Here's what often helps. A lot of times people like to see this because I've got a dividend rate of 6% with the insurance company, but that doesn't help me because the growth is different with different products. So usually what people like to look at is this, which is the annual IRR, net growth rate year over year, and then sometimes this, but in dollars, the annual cash value growth or total gain. A lot of times we'll show that in videos. But what we've got here, first year, negative 10%. The reason why, because you pay in $100,000, you've got $89,000, just about $90,000 in cash value, which is a $10,000 loss, no matter how we spin it. That's where we come up with the negative 10% annual IRR. The next year, or I should say, so at the end of year 1, you've got 90,000, just about. Year 2, you pay in 100, and your year 2 cash value is 186, call it 187. If it was money under your mattress, if you had 90 grand and added 100 grand to your mattress, how much would your mattress now be worth? 190. What is it worth here? 187. Your mattress has appeared to eat some of your money up. That's what you want, unless it's helping you sleep. But point here is we're still in the red in year 2 because we got less than what we paid into the product back. Year 2, positive 1.69. The reason why is because you're at 186. You paid 100. If you only got the 100 back, it would then be worth 286, and that IRR would be 0%. However, it's worth 291. That's why we have the positive growth rate on this spreadsheet. And you can request these reports with most insurance carriers as well to have it on their PDFs, on their literature and such. But there we go. Cash value continues to compound. And when we look at the internal rate of return, you see a difference there across the board. You can see which one's the strongest. Question is, am I into the idea funding 10 years or less, and I want a product that maximizes my internal rate of return? Or do I like a little bit lesser IRR, but with a product that I can continue to feed the beast and keep pumping money into it for a long period of time? It's a personal decision, because frankly, people we work with go both ways. Like, it depends on what they prefer, how old they are, how long they want to fund it. What I'll say is most people funding larger dollar amounts, 6 figures and up, will often go with a product like this to maximize the performance. Know they can fund up to 10 years. A lot of times they fund for a shorter period of time and just have a large bucket of cash they view it as a safe area to position money that they can use as a personal line of credit for opportunities and such. But they know they can fund it for 10 years, and they usually state, if I want to keep funding it after that, I'll just take out another policy, and maybe it'll be even larger. But I'm comfortable with 10 years or less, just seeing the performance on all of them. The risk you run there is, what if something happens to my health and I can't take out another policy in the future? But as long as one has awareness on that up front, in my mind, you've got enough information to make a decision where you can have confidence with your decision. But anyway, I hope you enjoyed this one. This is one of my favorite things to go through, because it really allows one to see how they can have a policy that's maximized for cash value. You've got flexibility. So my minimum premium's $10K in all of these. Might be $12,000, my true minimum commitment with different riders and such. But a lot of flexibility, commit to the minimum, add more discretion, and then I've got maximum cash value that I can access for opportunities as the years pass. So I hope that you enjoyed this. Please let us know if you did. If you have any questions or would like to see different samples or products, please let us know in the comments below. And as always, I hope this helps. Thanks so much. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.